You're back, and I'm back, and it's nice to see you again. There are a few people here that I actually run into periodically during the year apart from this conference. I think I see some of you more than I see my own relatives, but it's very nice, and I hope the relationship continues. It reminds me a little bit, the storyline is very different, but this goes back maybe 20 years ago. There was first a Broadway play, then it was made into a movie called Same Time Next Year. Most of you are too young to remember it, but in any case, for those of you who do remember it, this is what reminds me of it. It's always a pleasure to come back because you're all such nice people, and Experian puts on such a great show every single year. As usual, I have a lot to discuss. I'm going to try to leave time for questions. I have one story to tell you, but I'm not going to do it up front because I don't want to use the time. If we have time at the end, I'll tell it to you then. But let me give you some general outlook of where I come out and what I think is ahead, and then we'll talk about all the specifics in a moment. I don't think the economy is going to do what the Mets did. And that is choke and collapse. Well, not choke, but collapse. I know you're hearing a lot of gloomy forecasts these days. It's hard not to hear them. They're all over the talking heads on the TV programs, all the newspaper stories. Some of the economic statistics look weak. But as I'll tell you in a few moments, while this is not going to be the greatest boom in the history of the United States, and that's not going to be a surprise to you, and while there are some very serious problems in parts of the economy, also not a surprise to you, it is unlikely, in my opinion, that this is going to lead to the kind of deep recession or economic collapse that many of us fear, that has happened in the past on occasion in this country. But as you'll see in a moment, I think conditions are very different now, and that kind of outlook or that kind of occurrence, in my view, has a relatively low probability. Let me start with a very, very brief historical review and then talk about the most critical question now, or one of the most critical questions, and again take a different view than some other analysts and economists are now taking. And then it'll lead us into where we are now and what the outlook for the economy is going forward, and the outlook for interest rates and consumers and the things that you are very interested in. And I'll try not to repeat some of the stuff I know you heard at a presentation here yesterday. I think you all have a general idea of the rough pattern of the U.S. economy in the last 15 years or so, a little bit more than that. We had an extraordinary run of prosperity in the 1990s. We went the entire decade without a recession. 10 consecutive years of economic growth, not only a long period, the longest ever without a recession, but it was pretty strong economic growth. See, when you go that long without a recession and the economy is moving up at a rapid pace, you have a lot of prosperity, and that's what happened in the 1990s. And as soon as Business Week or some of the other publications printed their cover stories after that, gosh, the business cycle is dead and buried. We may never have another recession. Sure enough, about a week later, a recession started. And I think all of you know we went the first 3 years of this decade, from early in 2000 to spring or so of 2003, alternating between recession, stagnation, and slow growth, essentially a 3-year period of underperformance in the U.S. economy. And, of course, those of you who remember the stock market, it was accompanied by one of the biggest declines in the stock market in our history. I think many of you Also know that just when people were saying, my gosh, we're never going to get out of this mess, things began to improve. And it became noticeable in the spring of 2003, and ever since then, so we're now 4.5 years later since this period of recovery and economic growth began, that's what's gone on. It's been a continuous